Hello, Oracles. Welcome back to our Friday Night Live. We have back on here Adam. You guys may remember him from before. Speaking a lot about the macro environment. This is kind of important to know. We noticed last year Tesla came down when we thought it could never come down. Sure enough, it did, and we tried to figure out why. And a lot of it had to do with the macro. We can discuss Elon and Twitter all you want, but the macro did play a big role in the entire market, and Tesla fell with that. So today we're going to dive into some of the things that Adam has seen in charts and other different areas that may affect Tesla in the near and medium term. But again, those of us who went through Investor Day, we know that what's going on long term. That's what that whole event was. It was for the long term. So this is going to be a time right now where we're going to be discussing what's going to be happening in the near term, how we can see the macro environment. So Adam, welcome. How are you doing, sir?
Thank you very much. I'm very good. Thanks, Tim. It's always a pleasure, never a chore. It's good to be back. I think you had me on, I think it was November, perhaps. I can't remember.
Yeah. Several months ago, before the end of the year, for sure.
Yeah, that's right. When we were sort of looking at the stock price, and we were kind of like, yeah, there's going to be further falling.
And again, to preface this for everyone, we are both bulls. Tesla bulls long term. So Ab and I both think that the company's going to do extremely well long term, but the macro environment and economies are kind of questionable in the near and medium term. And it's just good to have this understanding. So you want to make sure your emotions are out of the stock, but I know sometimes it's hard. So when the stock is coming down for an unknown reason, especially when we get great news like we did, we need explanations, something that's going to clarify that. And this is what we're going to go over tonight, is a lot of the reasons why we may see that potentially happen.
Sure. Yeah, I think that's sensible. And just a little point just on what you mentioned there. You used the word emotion, which is a great word. We're all human. We all have emotions, that they drive behavior. This is something which I learned many years ago. If you are particularly feeling emotional over price action, you are overexposed. It's as straightforward as that. You need to be cautious. So So just going back to the point that we're both Tesla bulls, meaning that we believe in the company, we're bullish on the stock. Both of those things are cohesive. That is the case, but that doesn't mean that I would go and chuck in everything that I've got into the company to the point where I couldn't eat. That would be a very risky strategy. I'm not saying that you shouldn't do that or you should do that, but it would be a risky strategy, to say the least.
Yes, everybody has different risk tolerances. If that's the way you want to roll with it, everybody has to make their own choices and their own decisions when it comes to investing.
Yeah.
So that's on you.
Absolutely. Yeah. So full disclosure, as I said to Tim just before we came on, I haven't had a chance to watch the Investor Day stuff. The reason for that is, quite frankly, I'm in the UK. It started, I think it was 3 p.m. Was it Pacific time or Central time, whatever. Either way, I was asleep at that time. And then I've just had a couple of days of just not managed to catch up. I've seen a few of the sort of points that have come from it. And it's interesting. I think it's kind of sticking to the plan and growing, and that's good. Yeah, I think the overall summation that I've seen from just a few bits and pieces is it's all positive. We're moving forwards. However, if you've got a sailboat and you are trying to sail into the wind, it is difficult, very difficult, and you have to tack and make changes to your course as you go, and you get there eventually. And there are larger forces that will affect Tesla. And I think that's one of the things that I wanted to talk about this evening, which I think is interesting.
That's actually a great way to put it. Is Tesla is realistically just another ship on the water. Sure, it's a giant ship, but it still has to deal with the ocean and the wind and the weather. And it's still going to be affected by that. Regardless of the size of the ship you have, it is still going to be affected by all of these other outside forces.
Absolutely. I mean, it's an analogy I came up with. I grew up sailing, and it was something that you always had to be aware of the tides. In the area that I'm in the UK, we have very strong tides. And so it doesn't matter how expensive or good your sailboat is. If the tide is particularly strong and the wind is against you, it's hard work to make progress. It doesn't mean you can't make progress, but you do. But it's certainly more difficult.
Yeah, and you have to put in a lot more effort to move the same distance you would as if the winds were at your back.
Absolutely.
So that's really what it is.
It is. And if you were to take that and be analogous to Tesla, you've got a fantastic yacht there, but it's still hard work. So even if you've got something that's great, it's a racing yacht, it's designed to do everything it is, it's got the best tech in the world, and so on. Need I go on? You get the point. It makes sense. We've still got significant headwinds here, and that's what I want to look at. And we're going to look at that through some data, not my opinion, but through some data. And I think that's important to be objective. A lot of the stuff on YouTube, not so much yours, Tim, I'll be frank. I've watched quite a few of your videos, actually. I've been on quite a few flights recently, and I've got the YouTube Premium, so I download them and just watch them and listen to them. You're a lot more objective, which is good, which is one of the reasons why I like coming on here, which is really important.
Thank you.
So the more, no, but you're welcome. I mean, it's credit where credit's due. People are very quick to criticize, but less quick to give credit when it's due. And I think it's important. It's very easy for everybody to have opinions about things, and you find this with in particular, analysts and economists. They're always like, well, this could happen, but also this could happen, but they never give you an answer as such, and it's kind of, that's like, well, what are you actually saying here? And what they're really saying is, we don't know.
Yeah,
that's what we're saying. So
yeah, and as Marty says here, is when they're going back to the boat thing, as long as the propellers are turning, eventually the tide will be in your favor, and that's true.
Yeah.
And that's why Tesla is still chugging along, and eventually the economy will turn around, as we'll discuss tonight. So eventually the economy is going to turn around and will be in our favor again. And because we have that strong boat and the best tech, we will end up doing the best once it turns around.
Yeah. And I think, and I think a point to add on that as well is, tides are different all across the globe. Tesla is a global company. Whilst you've got sort of significant hotspots in terms of production, etc., and it's a US headquartered company, the product is global. And this is opinionated, but boots on the ground here. I'm in an office building. We've got 45 companies in here. 2 years ago, there were no Teslas in the car park. Now there's 4, right? And this is not. This is not Southern California. I mean, this is the thing. So you are seeing more and more vehicles on the road, and this is important. This is the stuff that if you've come across the sort of Peter Lynch style of investing,
yep,
right. This is the real sort of stuff, and this is where you're starting to see the public start to wake up to things as well. What you saw in, I guess, sort of little Q2 and onwards of 2020 was really kind of like a mania hype train. Now you're starting to see more considered retail investors starting to look at this a lot more seriously, and that's quite important to understand, that you're not just seeing just the ETFs going, okay, we'll do it. You're now starting to see people go, yeah, this is actually quite sensible. Now we're starting to see a genuine transition here. And there's often a big lag with things such as Investor Day and so on. It's not that Wall Street don't understand what's going on. I've seen certain tweets by people saying Wall Street don't get it, etc. You may have seen similar tweets. They do get it, but they're in this market that we're in at the moment, which is not a bear. It's not a confirmed bull market. Investors are cautious, and rightly so. And we're going to talk about why as we go and have a look at some.
Yeah. When you've got uncertain times, big money in Wall Street tend to have a shorter time frame. Instead of looking out 12 to 18 months, 24 months, they're looking 6 to 12 months instead. So because they don't know what's going on, there's so many uncertainties in the market. It's not a bull market. When we were in a bull market for the last 10 years, you're like, all right, clear sailing. Let's just go ahead. We're good. We can look out long term. That's why you see such high PE numbers on a lot of stocks, because they can see further out. Now we see that shrink because we have the uncertainty.
And that coupled with I think the latest print, we could pull it up on the chart, but of the currency supply, which we've spoken about before, we're still in a currency contraction phase. And what that ultimately means is that there's less money sloshing around. But how does that happen? And what that means is that that's typically credit lines. So when, let's say, a huge company goes to one of the large banks and says, hey, can we borrow 10 million or something, the answer might be yes, but it might be at a slightly higher rate, or the answer might be no. And you're starting to see those things. So we're starting to see a currency contraction. Now, as to when that will change, I don't know. but we could have a look at that chart as well. But
Yeah.
anyway, but a lot of this is going to be focused around this pivot, which people are talking about, and what ramifications that is likely to happen. None of what I say is certain, but history does leave clues, and human behavior is very predictable, to say the least.
Yep. I am a history major, and
Yes.
one of the things that I got from being a history major, despite not using my degree, I don't know a lot of details about history, but that is exactly right. What I learned over history is patterns. There's a lot of patterns that form, and a lot of those patterns are based on human behavior. So if you learn human behavior and those patterns, you can see a lot of this coming pretty clearly.
I would argue that you took a lot from a history degree. Then actually, I think that's most
I took the important stuff.
Well, I would suggest that a lot of people are not aware that things repeat. They don't always repeat identically, but you can certainly spot patterns from history. So it does leave clues. So that's important. So what I'd like to do, Tim, if it's okay, is share my screen and just go through a few bits and pieces, if that's all right. So I'll do that. I think it's just I'm just trying to see where to do it. I'm trying to remember. So it says present, and then it share screen. And that is the one I want. So let's start with that one. Right. I know I want the window. There we go. 1 second. My apologies.
No, it took me a while the first time I did it too, so I totally get it.
No, that's all right. I'm a Luddite when it respect to IT to some extent. Right. Can you see my screen? Okay.
Yep. I can see it. Let us know in the comments if you guys can see it all right. I guess I can see it well.
Yes, please do. Yeah, please just give us a I was going to say give us a thumbs up, but whatever the thing to do is now, please do. So I don't think there's any point in patronizing anybody or anything like that. This is one of these kind of go away and read about these things if you don't know what they are. I think it is important with respect to time. So what we've got here, so this is a Federal Reserve, basically. You may have heard the expression, don't fight the Fed. It's a good expression for a reason. So what this is showing us is a federal funds effective rate. That's what this is. It just means interest rates. That's what it means. It's the same thing. They're interchangeable terms pretty much. There's a couple of nuances. Right. Does that make sense so far, Tim?
Yep.
Good. Cool. So we have got some data going back to 1955 of what the interest rates have done. And as you can see, they've kind of done what they've done. And, we've had sort of, very high interest rates of sort of 15%. And then we've had these sort of golden times of sort of near zero interest rates and so on. And then we had the COVID scenario to try and boost the economy of lowering rates. We thought rates would go negative, but I think they did in some countries.
Adam, just a quick jump in. Can you turn your microphone up a little bit?
I think so. That's a good question. Let me just check how I do that. I can move it closer to me. Is that any better?
Yeah, let us know, guys, because I can hear him better now too. You let us know.
Yeah. Okay. Yeah. Well, yep. We are we good?
Yeah. Go ahead. I can hear you're definitely louder to me.
Okay. Good. Yeah. I just moved it closer to me, so that should work. Cool. Okay. All right. Sorry about that, Tim. Okay. So this chart, as I say, is one of US interest rates going from 1955 to the present. And the grey bars indicate recessions. So, and these are defined as 2 or more quarters of economic contraction. That's what we're looking at. GDP contraction, negative, essentially. That's what we're looking at. Now, this on its own doesn't sound very exciting, and it's not. But what I was interested in is what happens to the overall stock market when interest rates go up or down. And most people would probably think they've got the answer to this. And I thought I did. And I was not right. And that's good. I like being wrong sometimes, certainly around this type of thing. So what I did is I did this. I made things even more complicated for myself. And I superimposed here a graph of interest rates, which is the blue, against the S&P 500 in orange. This is a horrible graph to look at. Absolutely horrendous. Can you see it okay?
Yep.
Good. Right. this, when you look at this, you'd go, what the heck do you do with this? You'd go, what on earth's going on? So what I did is I started to go, let's start to have a look going back here, and let's start to look at what's happened. Let's take an example of around the .com times. Now, you can do this with any recessionary period, and let's start to have a look. So I'm going to go from January 2000 to, is that right? No, it's not the best interface on here. Here we go. I think that's, let me just drag it out. Whoever builds their website, it's not beautiful, but it's a government website.
Probably the government.
I was going to say it's a government website. Somebody will be paid a huge sum of money to build a website that's not the most eloquent. But anyway, we'll get it right. That's 1986. Let's pull it along. There we go. Somewhere. I tried to have these preloaded, but they time out, which is frustrating.
Oh.
Yeah, so it's kind of it's a bit annoying. All right, we're almost there. Okay, right. Now, let's have a look at this. So, in the run-up to the .com scenario, and for those who are not familiar, the stock market took a huge battering during the .com, which was the early 2000s. It doesn't matter when it was. What matters is what happened and why it might have happened. So, as you can see here, the rates were sort of 5.5% going and so on. And then what happened in June, the Fed paused raising rates. What do you think happened to the stock market in June 2000?
Well, if we're looking at history and people say that when the Fed pauses rate raises, the market should go up.
Right. Okay. All right. And then what do you think happened when the rates started to decrease as they did? And they decreased from 6.5% down to 1.82.
You would think theoretically the market should go up.
Okay. All right. And that was my mental model as well. That was exactly my mental model. Now, this is interesting. So let's have a look at what happened. So here we go. Apologies for the pop-ups. I'm a bit tight. I stopped paying for TradingView after a while. They kept betting the prices up. I was like, oh, man, come on. Give me a break. Okay, so here we go. Let's start to move along here a little bit. So this is a daily chart. So this is 2000 down the bottom. I appreciate some people might be watching on mobile devices and smaller devices. Might be a bit difficult to see. So we're moving now into, this is May. Now, here we go. Here is into June. Now, there you go. The Fed paused. So what happened? There it is. The Fed paused, and what happened for a very short time, about a week, exactly as you identified, it went up. and that's what we would have expected. And it went up by about 4 or 5% was what it was. Okay. Now, and then it had a little pullback as markets do, and that's fine. And then it pulled back and so on. Now, this is where it gets interesting. Look what happened here. Notice this particular area here.
Yep.
Now, this is interesting. Now, rates are still paused. So we're going back to this. Remember, the rates are paused until
December.
Yeah, that's right. Okay. So look, so rates are paused and the market's falling. Now, this is interesting. This is full. Look at this.
It's just straight down.
Right. Now, this is interesting. You wouldn't expect this. Okay. This is it. Now we get to December. Now the Fed starts aggressively decreasing rates until December 2001. Let's have a look what happens until December 2001. And I'll give it a little bit of a zoom out. There we go. To December 2001.
That's not up. Well,
No, it's not, is it?
I mean, it's just ugly, but
Yeah. So let's have a look at this just to give a bit of clarity from that there, top to bottom, 30%. It dropped 30% and rates were going down. Now that to me, I'm like, and then look at this. This is very telling. Now, this is where it gets interesting. Once we got down to this point, and then the rates were at the drop down to the lowest or local low, so to speak, as in they didn't really go that much lower. It was 1.7, and it got down to sort of 1. Granted, that's a halving, but it's a huge percentage difference from 6.5. So then we look at sort of January 2022.
And then the one thing to point out too, timing wise, is September of 2021 was when the World Trade Center was hit.
Yeah, I mean that's a news event, and I would agree. I would probably say that probably
would have, I would say it would be like for them, because it took a little while, maybe like a 1 or 2 month COVID style.
Yeah, I think when you look at that, and that's exactly what you're seeing here, is you've got a bit of a lag here when you're looking back, when you're looking at this sort of thing. I mean, this 11th was, I mean, to be honest, looking at it,
it was already falling before then.
Well, if you look at it, I mean, if we look at no, the market was flat. I don't know what day of the week it was. I'm pretty sure it was a working day, wasn't it? Yes, it was.
Yeah, it was.
Yeah, no, it was flat. Nothing. It's yeah. So it didn't seem to affect it. The next day, yes, absolutely.
Right.
You then had a sort of flee to safety for sure.
Right.
So this area here is probably noise, I would suggest.
But then after a week, of course, very similar to a lot of things when there's uncertainty, as soon as we got that clarity as to what was going on and what was happening, the market rebounded and recovered back to where we were before that happened.
Exactly. You've got that going on. You've got a straightforward V-shaped pullback. Yeah, exactly right. And then now this is where rates have started to do what they were doing. Now rates are low. Look, we're still going down. And this is bringing us into 2022. So if I had to zoom out on this even more.
So that's definitely very contradictory to a lot of mentality of when the Fed pivots. And I know that I've seen charts. I know Chicken Genius can put out a chart a while back about when the Fed pivoted on the rates, we actually saw a tank afterwards for 6 months. And then it did recover with a V-shaped recovery. But once it got back to the level it was before they pivoted, that's where it was, all right, now there's going to be something else involved as to what's going to transpire going forward.
Yes, absolutely. Now, the very interesting bit from this that I take from this is I don't mess around with the sort of short-term stuff too much, but I pay attention to it. As in, I wouldn't trade it, but I am interested in it. So we go back to this particular scenario here, which was when the initial pausing happened. That's, or I suppose more accurately, this here. For a couple of weeks, you saw a sharp rally. Now that's it. Now that seems to be a theme here. I'm certainly not going to go through all of these, but these seem to follow a theme. So what you've got going on is the Fed paused rates, and you saw a rally, which makes sense. But then when rates started to decrease, the market crashed. Now, that's against what you thought was going to happen and what I would thought was going to happen. And there we go. And that's it. And that's interesting.
Now, going back to that time frame, my question is, obviously we know internet tech, the .com bubble, all of that. That was a lot of just money coming in because they thought the internet's going to open up the world to so much.
Sure.
And of course, we know over time it did.
Yeah.
But at the same time, what was going on with credit? Because obviously we went to the housing market and there was a lot of money getting lended out to people who shouldn't have had it. Was there a lot of extra money floating around back then like we're seeing now?
Nowhere near of the scale there was. And I think that's a really good question that leads into the next one, which is let's have a look what happened around the time that you're talking around, which is that subprime. I think that's a logical point to move onwards. So let's have a look at that. Let's go on and have a look. This is gives me horrible scaling on here. It really is. Right. Here we go. So can we do right? Yeah, that's good enough. Okay. So here we go. So June 2004, 1% rates. And then we go up to 5.25% in 2006. So we had rising rates for a couple of years, and then it flattened out.
Which is very similar to the exact, well, now granted, we're doing it a lot more aggressively right now, but we basically went from under 1% to almost 5% we're going to be getting to within the next few months.
Mm-hmm.
So it's almost, it's very similar to that.
It is. And then in July 2007, aggressive rate reduction down to zero, effectively. So what would you have expected the market to do from 2007 with an aggressive rate reduction?
I mean, again, based off of the, just the rates themselves, I would think the market would rally.
Right. So let's have a look at that. Let's go and have a look at that. So I have a trusty chart that is ready here. And we are into, this is April 2006. Let's give it a little bit more scope. So let's have a look. Let's sort of move on. So when did so it was July 2006. There was a pause rather than a pivot. Pivot meaning changing direction, but there was a pause. It's a change of velocity, but we'd call it a pause, really.
And that's literally, and that's for you guys who aren't aware, this is what the Fed has been talking about, is they're going to pause and basically hold rates steady where they're going to be at for about a year.
Yeah, absolutely. And if we look at this here, that's exactly what happened from July 2006 to July 2007. That's what happened. The rates were steady at 5.25%. So that's exactly what happened. So let's have a look at what the market did from August 2006 to from July 06 to 07. Let's have a look. So we're going to come in here. So we're now moving into, here we go. So here's June, July, and here we go. So paused, and everybody went,
yay!
Well, hey, we've got, rates are not going up. And then you see it, here we go. Up, there we go. And bear in mind, this happened, remember, rates are paused for a year. So we're now looking at this going through it fairly quickly. Just I want to be conscious of everybody's time. And so look, here we go. Now this is kind of what you'd expect.
Right. Fed pauses, so we get this excitement and a rally because we're expecting a pivot coming afterwards.
Now, but the pivot is here. What's happened to the rates? Look.
Right.
They're plummeting. So you'd think
that the market would continue rallying.
Absolutely. Absolutely. That would be, and by the way, there are not going to be many people on YouTube who will be looking at this. I really don't think so. I don't think many people look at this type of historical data also at this detail. But what happens? And here we go. This is where we started it, to lowering rates. And how long did it take to get down to the bottom? December 2008. So let's have a look. Interesting.
And as AYMR here points out, we're not taking into consideration why the Fed is decreasing rates, and that's what we're going to be discussing. Also, is just that. Obviously, the Fed's moving rates one way or the other for a reason of what's going on at the time. But a lot of people recently have been strictly looking at Fed rates, saying, "Hey, the Fed's raising interest rates. That's why the stock market's down." Fed should be pausing, then the stock market should rally. And again, looking at the reasons why it's happening, that's important to look at as well. So again, you've got to look at many other factors.
There are many, many other data points, and this could be 6 hours, and we would only cover 5% of them, perhaps. And I'm aware of that. I'm just looking at a couple of metrics here that I think are useful for people to get. So we had from that from that rally that happened. Now this is something that I've noticed as well, is what you tend to find, and this happens every single time I've found, is when the rates get raised. When the rates get lowered, or there's a pause, you get a rally, and then you get this. You get a new all-time high, and then it crashes. And that's the same with the 2001. You got it. You got this sort of it was very close to an all-time high, and then a crash. Now, whether history will repeat itself, I don't know. I'm not here to say that, but we're seeing what looks like a very similar scenario. Now, if I just bring this chart out just on this, and
just to jump in, so Jerry here, subprime mortgages. So again, the reasons were like the dot-com bubble. Obviously, a lot of people were buying into companies that didn't exist. So there was that, and Fed was doing whatever they were doing with the rates. And who else had said it? Hold on, where was it? And then as Todd says here, the market's forward-looking, Fed is backward-looking. Very true. So the Fed is reacting to what is going on in the market. So when we're looking at this, but again, despite what was going on, the first time was the dot-com bubble. Then we had the housing market bubble. Now we're in kind of like the COVID recovery bubble. Every time there's a different reason, but the market seems to react the same way as to where the Fed rates are going, and it's contradictory to what a lot of people think.
Yeah. And these are all valid points. The way I'm looking at this is I don't care what the problem is, whether it's a housing market crisis or housing shortage or a virus or a nuke goes off or whatever it is. That doesn't matter necessarily. What matters is that the way that the reaction is, and it will be the same each time. That's what we're showing. We can look at this with the oil situation. When this happened, the crisis in the end of the 70s, rates went nuts. But
back then, it was awesome. For those of you guys who are old enough, I was very little, but I had money just in a basic bank savings account, bringing in like 3% in a savings account. You're never going to see that again.
No, this is it. I'm getting offers now from one of my basic accounts. It's just good, hey, you can have 0.4%. I'm just like, yeah, whatever. Well, with currency expansion at around 15% a year, you're losing money. It's like, it makes no sense. But most people are not aware of that. So the point I want to make here on this is that when there's a pause on this, and I'll come off this for a second. I'll come back to it. Is when there's a pause here, there tends to be a rally, and then it tends to crash. But it tends to crash after it's taken out that all-time high or very close to it. Now, will that happen again? Difficult to say, but it's happened every single time that I've gone back through the data, and those data go back to 1955. Now, if you can find data that goes back further, I suspect it will confirm that also. So that's if there's a pause. So you tend to find that sharp spike in the rate leads to recession, which is what we've exactly seen that. And that's happened every single time. But when rates drop, the market dumps. Now, that's interesting. So that's where we need to be careful. So if there's a pause, you're very likely, I would say with about 90% probability, this is not financial advice. Take it as you wish. But looking at the stats here, and just purely looking at those graphs, and those graphs, by the way, they are plots of human behavior. That's what they are. People could say, yes, it's bot trading or it's algorithmic trading. Yeah, but who programmed the bots? Who programmed the algorithms? It's
Exactly.
human behavior. It's as simple as that. People think they can build bots that will outsmart this stuff and so on, but it doesn't work. It's just somebody will build something smarter and so on and so on and so on. So the point that I'm making here is, if you were to take all of human history, and Tim, you'll understand this, what would make anybody so, I don't want to use the arrogant, I think it's not quite the right word, maybe just south of arrogant, to suggest that human behavior has changed in the last 100 years, compared to how long we've been around. It's the same things drive our behavior now that did 50,000 years ago.
Right. And humans have only been around for a blink of an eye as far as actual history goes.
Absolutely. And if you get even deeper into it, which is more some of my work perhaps, but ultimately human behavior is driven by pleasure seeking, avoidance of pain, conservation of energy. And that leads into two things: survival and reproduction, which is food and sex, which is replicate DNA. It's all animal behavior. Doesn't make any difference. So when you're looking at these graphs and you're going, trying to be clever using graphs and so on, they're just plots of behavior. That's all they are. Nothing more than that.
And that's actually something that I've learned over the last couple of years in diving into the charts. Is it's really psychology, more psychology than anything. Like, yeah, you can read the charts, but if you understand human behavior and psychology, you're going to understand the charts a lot better. And yes, charts are usually more for near-term movements, but even when you look at it at a broad scale, you can understand how the cycles are going to move. This is why every 10 years, we usually see cycles in and out. We go through a bear market, a bull market. For, again, the catalyst for it could be anything at all. Yeah. But it's always usually around that 8 to 10 year time frame that we get that cycle, and it goes through. And last time Adam was on here, we were talking about when people are looking at generational wealth, how long is a generation? Typically 30 years, because when you're going to have a child, usually you're around 30 years old when you have a child. So that's 3 cycles every generation you're going to be going through for this.
Yeah. I mean, it's an important point. I'll pick up on it again. And this is to help people. It's not to sound smug in the slightest. It's to help people. Is that when I see people posting, I'm a long-term investor, and I don't need to ask the question very often, and they'll be, I'm a long-term investor for 5 years. That's not long-term investing. Given that we know these cycles are approximately 10 years, if you're buying at all-time highs, which some people will, who are watching this, particularly with Tesla, some people will have bought around that sort of $300-400 mark, and maybe thinking, shit, if you're in it for generational wealth, whatever.
You're fine. And this is what we talk about all the time on here is, some people, and it stinks. I got in at the higher level, so I'm still upside down on Tesla. But again, when you're looking out time frame 2030, even if you think it's only going to be worth $1,000 in 2030, that's still a 5x on your money in 7 years. So
and you'd be hard pushed to get that return on capital invested, certainly return on time invested, unless you are very, very good at trading or you have a business. Those are probably the only 2 ways that I could think that you could get a better return on your capital invested. That's the reality of it.
Yeah. So one question I would have, when the Fed paused rates, and I don't know if we can find data that goes back that far for it, but looking at every time they paused rates and we saw that rally going up, how much of that money going in was retail money versus institutional money?
Almost all institutional money.
It was all institutional that drove it up that high?
Yeah, and I haven't got it open at the moment, and I'll find it and send it to you, and maybe you can.
Oh, cool. Okay,
but it seemed to be a lot of BlackRock and Vanguard and et cetera, et cetera. Yeah, and that leads me on to another point, actually, which I think I will. I'll just share my screen again just for a few moments, Tim, if that's okay.
Oh yeah. And the reason I had asked that question is because we just saw reports coming out that right now, retail investors have invested over $13 billion into Tesla so far this year. Last year was a record of $17 billion. So within 2 months, by the time we hit March, we're going to eclipse that record. So just wondering how much is out there. And now for you guys, this is not to scare anybody, but just remember, a lot of the pullback that we saw last year and the exaggerated pullback was a lot of retail investors who had either, gone into margin or had options out there. It was a lot of fluff that was in the stock that ended up getting flushed out. And then you had people who, we'll call them paper handers. They were afraid, they didn't have that same conviction, so they sold out as well. So with a lot of retail money coming into Tesla right now, with this going on in the macro environment, we could potentially see a more drastic pullback than we see in the macro environment just because of that.
I think they're good points, and I think that's something. Tesla is somewhat a meme stock, but it seems to degrade it to call it that. But it does fit into that category to some extent. If you were to draw a Venn diagram, it would overlap.
It would be like if Apple had meme swings, is really what it is.
Yeah, that's it. I mean, Apple obviously is an entirely different entity. It's been around for much longer. Is very matured, etc. It's not a startup. Tesla is still working as a startup,
right?
And I think will continue to do so because of the way that the company culture is.
Yeah.
Personally, I think that's fantastic.
And I mean, they still have 3 more startups that they're working on within the company.
Yeah, exactly. I mean, it's just it's great. But the points that you make here, and it's very true, and this is a point that I was going to make on this. Let me just bring this back up. Let's just have a look. So I wanted, just on. There we go. Which one was it? Oh yeah, here we go. Yeah, so this one. Oh, this is just sharing this tab. Actually, let me just go back.
Oh yeah.
This is quite a good one actually. Yes, green Chrome tab. That's what I want.
And as you're doing that, well, because this is going to tie into it in a minute. The $25,000 car for Tesla, which they discussed Giga Mexico. We're going to have the next gen platform coming out of there. We know one of them is going to be the compact car. As Karav here says, it's possible that, in the year. So by the end of 2024, beginning of 2025, based upon the speed that Tom Zhu wants to have that factory up and running, he wants to break ground in 3 months, have the factory built in 9, and then volume production could be coming by the end of 2024, beginning of 2025. Now that timing is going to play very much into what we're going to finish discussing here with the macro environment.
Yeah, absolutely. I think that's that's kind of important actually. So let's have a look. Window, right? There we go. So, right. Okay. Can you see this tweet here?
Yep.
Cool. Right. So this was a tweet that I saw yesterday. Can
you expand it at all?
Say again?
Can you expand it at all?
Yeah.
I don't know if you have a Mac or not.
I do.
Oh, okay. Yeah, because there we go. Oh, yeah, much better.
There you go. That's the stuff. Right. So holy shit, ETH took a big dumpy. Cool. Okay. Right. Doesn't matter who tweeted this. It's not the point. It's irrelevant. But this ties in with what you're talking about, Tesla and flushing people out and so on. It's just something I wanted to sort of cover. So it's true. And I went and commented here. I put, look at liquidation levels on the kingfisher.io. Lots of games being played. And what I meant by that is you can go and look at charts. And I'm not going to go into all of these now. It's the last thing I want to do. You can see where people have got buy and sell orders, and brokers can do this as well. And this is where it gets interesting, because if people have bought or set entry orders on Tesla at a certain level, the brokers can see it, particularly if they're lots around the same thing. So this is market making stuff. You'll have talked about this before, so I'm not going to go into detail of it. But this was a very good example of it, and I put fancy a clue here, because when I looked at the daily chart, what can you see happening here? And this is not Tesla. We're talking about Ethereum here, but it doesn't matter. What matters is the behavior. And so there were lots of people, and when I looked at liquidation levels, I could see lots around 1550. And what did it do? It bust through 1550. And what does that mean? Lots and lots of people essentially got vaporized. And that will have been exactly the same thing that will have happened with Tesla. Exactly the same thing. So, again, folks, it's one of those things. Be very careful with margin in this environment. Going back to what we looked at and what it's shown is, when there's a pause, we're going to see a rally, and then we're going to see a crash. But we're likely to see taking out an all-time high or very close to an all-time high.
And that brings in, and now to the human psychology side of things when it comes to retail. This is why I asked that question, because a lot of times we start to see that and we get the FOMO people coming in. Now, we also have to remember, this is the first time we're going through one of these cycles where we have free trades, because prior to, it was like 2015, people had to pay for trades. So a lot less people were trading. We didn't have the gamification of trading in the market like we do now with all the apps like Robinhood and all that. So we have a lot more retail investors coming in who are not familiar with these patterns, and they have this, short-term mentality. It's more of a casino type atmosphere for them. So what ends up happening in the market is it's a transfer of wealth from the impatient to the patient. These people coming in, gamifying it as retail investors, are impatient. They're trying to make money very quickly. So that is just, they're going to be taken advantage of by the patient people, by the market makers who know these people are ready to dump in a lot of money. They're seeing this run. They're going to try to make a lot of money. We're going to pull that rug out from underneath them and take all their money for themselves.
Yeah, absolutely. And if you've got an itch to scratch and you want to do that, fine. Open another account, fund it with whatever you're prepared to lose, and do that. That's fine. And I've done that for years, and I still do that. I still have that little itch to scratch, and I will do that. And maybe every 6 months or so, I have something great that happens, and then maybe I'll blow the accounts up within 2 weeks or something. It happens. But I wouldn't do it with the main account. I wouldn't touch it. But yeah, you're absolutely right. Is that there's more at play. So if you start to see that, and you start to see that rally, think back to what we've just looked at with respect to what happens if rates get paused. Now, when you see a pivot and the rates start to be, and I don't think this will happen, purely because of what Jerome Powell said. In the sense that we don't expect there to be a lowering of rates straight away. We expect there to be sort of hold steady. Yeah. But if there were, for whatever reason, there could be all sorts of reasons. I'm not going to speculate, but there could be all sorts of reasons. If there were to be a sharp drop in rates, if, for example, at the next meeting it came out and they dropped 50 basis points, which is extremely unlikely, but if it did happen, that's when you could see an insane rally, full risk on, and then a dump, absolute dump.
Yeah. And we've seen that. I mean, think about just the last 6 months. We've seen risk on and risk off flip-flop quickly.
Yeah. And that's what that federal funds exchange rate. And I would encourage your viewers to go and look on the Federal Reserve website, look at these things, and start to learn about these things, because these things in a macro environment, the more you understand about these things, and I still know nothing really compared to some people. Well, compared to most people, really, I think in some respects. But when you start to look at those, it gives you a lot more confidence and conviction with respect to a company like Tesla. You're fine. There's nothing to do with the company. They're doing what they should be doing. Market forces are way bigger, and that's okay. If anything, it presents a bargain. That's the way that I would be looking at this type of scenario.
Yeah. And if you guys looked at, and I don't know if you want to bring up that Fed funds rate really quick again, several of the times that we saw the Fed drop on the rates, we were in a recession. And it was when the Fed pivoted.
Almost every time.
That's when we hit that recession. So now going back to that timing of Tesla coming out with the compact car, there we go. Yeah. So, when you're looking at it here, it's, recession. Look at all those gray bars, or the recession. Look at every time the Fed has pivoted, recession, 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 every single time.
Yeah.
So again, looking at the patterns of history, chances are that's what's going to happen. So now when we're looking out to 2025, if 2024 to 2025 is when we are going to be seeing the compact car coming out, if the Fed is going to be pivoting in the middle of 2024 is typically is probably based on what we have for information right now, probably when it's going to happen is Q1 or Q2 of next year. If we get that recession happening, guess what we're going to want to have in the market? A $25,000 car. Timing is absolutely perfect for Tesla to be dropping this. So everybody who is freaking out saying Tesla needs one now, not to say that they shouldn't have one, but there wasn't as much of a rush. Them doing what they're doing to make sure that they've got everything, supply chain, and everything put in place for this to be ready for that is perfect. So now if we hit that recession and Tesla comes out with that compact car at the end of 2024, beginning of 2025, guess who now has vehicles to be able to handle a recession better than anyone else? Tesla. And they can produce the volume.
Absolutely. And there's 2 points there just before I come on to the Tesla point. One, I don't care which precedes the other and which is a leading or lagging indicator, because we're looking at historic data regardless. It doesn't actually matter. The data is already printed. It's irrelevant. But you are seeing that either pivot, or you're seeing pausing of rates and then boom, recession and market dumping. You're seeing that each time. There's nothing to do with Tesla. It's irrelevant. But something that I will maintain, and I'm prepared to stick my neck on the line with this one, Elon is still the world's best market timer.
Yeah.
Right? Yeah. If there's anybody you're going to trust with respect to a plan, and it's like, and yes, there's always been FSD 2 weeks and 2 weeks later has always been a joke, and I get it, right? Fair enough. And if you're trying to do these types of things, it's things don't always stick to plan, but they're at a point now, and this is a few things I did take from the little snippets I took from the Investor Day stuff. Absolutely, this is what we're looking at. I think one of your viewers did comment about the $25,000 car. That is where you're going to see a game changer. Absolute game changer. No two ways about it. And if that timing coincides as you've predicted, or predicted, it's maybe the right word, wrong word, it doesn't matter. But if you see that happening, that's an absolute. That's when my office car park won't have 4 Teslas in it; it'll have 24. Yeah. That's the situation.
Oh, right.
Yeah.
Yeah, and just thinking about and like you said, Elon timing the market, and everybody's like, oh, Elon sold at the top of all the times it came down. If he's that good at doing that, think about him timing with the company to come out with products at the market at just the right time.
The things he can control.
Yeah, the things that he can control with the company to be able to do the things for all of us as investors.
Yeah,
I mean, that's brilliant. So I think that timing is going to be absolutely crucial over the next 2 years. And the hard part is so many people have a hard time looking out 2 years. They can say, I'm a long-term investor. But as Adam said, some people think 5 years is a long time for me. And, Adam and I are both in health and fitness. When you're holding a plank for a minute, that shit seems like it's forever. So the same thing is when you're going through a painful time like we've been going through, it seems like it's really long, but it truly isn't. We'll get past it and we'll realize, oh, dang, I wish I did it more. I wish I bought more during these times. I wish I paid attention more. I wish I really saw what was going on in the market more during those times.
Yeah, absolutely. It really is. It's that's the scenario there. But I just thought it could be useful to share some of those data because you answered the same as I did when we were looking at this. It's what do you think would happen?
Yeah.
And it's converse.
Yeah, and it's definitely eye-opening. That's great information to have. So theoretically, and again, not financial advice, we don't know what the future is going to hold, but looking at history, if the Fed is going to be raising rates, right now the market's pricing in 3 more 25 basis point hikes. We're going to have March, May, and June. If that's the case and they pause in June, we may potentially see a rally from June until next year, Q1 or so. And then at that point, if the Fed is going to be pivoting, that is when we see that quick spike rally because they're pivoting, and then the pullback begin. And again, it'll be a pullback very similar to what we saw last year, which is a lot of dead cat bounces on the way down.
It won't be a straight line for sure.
It'll give us that false hope that, oh, this is going to be a V bounce, but it truly wasn't. Now, again, that's just based upon historical data that we've seen every single time this has happened. That could potentially be what happens this time around again.
Yeah, and I'm conscious of time, but I think it is just worth just showing this. But when people are talking, you talk about holding up things for periods of time, and it's true. I've got a drink here that probably weighs half a pound. Now I can hold it out for a few seconds. I don't notice the weight. If you ask me to hold it out for an hour, I'm going to notice the weight. Ask me to hold it out for 5 hours, it's going to be really heavy.
Yeah.
Right? You're gonna notice it. So yeah, I get that.
Isometric holds are not easy, but they're
no,
possible.
quite. So that's it. So let's just have a look at that for a second, because that's very interesting what we're talking about. So just on this, we can see this chart. Yeah, you can see this one.
Yep.
Cool. So just on this, so this is the bottom of March 2009, just around this area here. Okay. Now it looks like we're coming out of it. Absolutely, and that's what you've got. Now you had from the very bottom, which you're never going to get the very bottom, but if you had there a 40% uplift. Cool. You'd be like, wow, that's superb. But let's zoom in a bit. And this is people, we're all a little bit guilty of doing this. But then you started to see this sort of thing happening, and you'd go, well, I've just gone up 40%, and then it would go flat, and then it's just dropped about 7-8%, and you'd be like, yeah,
we're going back down again.
Yeah, and so it's all very easy to sort of say, oh, these things always go up, but be really ruthless with yourself. If you were here and this was happening, and you had significant holdings in whatever company, we look at the S&P here, but if you were looking at this and you're like, hey, this is we're going up, and you look at this, and then you start to see and you saw a bit of flat line here, and we sort of continued to rally, and then we saw more, and you're like, hey, this is great. This is going in months here, and so on. This sort of stuff. That was that 8% there. This could have flushed some people out.
Oh yeah, and it's almost like that reverse dead cat bounce on the way back up. It's like we're coming up, people are taking their profits, thinning some things out.
No,
and that's just and honestly, that is healthy for the market. We talk about it all the time. So when we see the Tesla pulling back and stuff, that's good and healthy for the market. So don't worry about that going up.
But again, this is where, and I'll finish just on this, but this is another good example here. If you look at this from if you bought in February and you're looking at this, you'd go, hey, I'm 15% up in 2 months, right? That's superb. What kind of, that's a fantastic return on time and capital invested. You'd be like, sweet. But what would happen if you were here? Look at this, 15% back down.
Yeah, just like we saw with Tesla being up over 100% in 2 months.
The Tesla. I'm not even going to bring up a chart.
Oh right, yeah, but still, I mean, it's the same human psychology that goes into it.
Yeah, and exactly, and this is the thing. So, markets move, they breathe in and out, and this is the thing. So it's, whether they're inverse dead cat bounces or whatever. The point here is just look at the bigger picture with this stuff, and take heed of some of these. Trying to trick the market, I suppose, is the right way of saying don't do that.
Yeah, take what the market's going to give you. Now, one quick question. I know we're going to get off of here in a minute.
That's all right. That's fine.
When we saw that bounce on the way back up, which kind of signified and gave us that start of the bull rally, what were the Fed rates doing at that point?
At what time? So we're looking 2006, 2007?
Yeah, look at so that 2009 point where we hit that bottom and started coming back up again.
Okay, so let's have a look. So let's just have a look in there. So we were here. So this is March 2009. This is the bottom, and then this is where we started to see an establish.
You got to share the screen.
Sorry,
that's okay. Right.
My apologies.
I can read your mind. Everybody else can't.
Right. Let's have a look. Okie dokie. Right. So here we go. Sorry, you can see now, yeah?
Yep.
Super. Okay. So here we are. So this was March 2009, and this is when we got into what we would describe as, if we look at this, we would say it's an established bull market. Yeah. I think arguably you couldn't argue that, given that there's over 4 or 5 years here, and continue to do so. So let's have a look at rates, what they were doing in March 2009. Now I'll try and get this as reasonable as I can. Okay, here we go. So that right at the bottom.
So once we finally hit the bottom and the Fed was like, all right, at the point where the Fed says we're going to stop lowering rates, that's when the market rallied and started coming back up.
Only after it'd gone from 5.25% to practically zero.
So now, keeping that in mind, with the Fed saying that they're not going to be dropping rates that rapidly this time around, they could be dropping rates for the next 3 to 4 years. That could be a 3 to 4 year time frame where we see uncertainty in the market and a bigger pullback.
Yeah,
I mean, Chamath said himself, he thinks 5, 6, 7 years we should be keeping doing that and flush the market out.
And he's lost billions over the last couple of years, but his time frame is decades.
Yes,
with respect to what he's doing. But yeah, and this is it. So, if we were to use it, I mean, that was a single data point that we'd use there for sure. But, you can play around and look at these things. But if that were to be the case, again, you would not be looking at, some point in 2024. You'd probably be looking closer to 2025 at least to get back into an established bull market. But that's bottom picking. Let's be really honest.
Exactly. Yeah. And that's, I mean, obviously timing the market isn't as important as time in the market, but if you guys who are out there are looking like, hey, what is it that is going to cause this to finally turn around? Like if we're going to go into this point where the Fed pivots, the market's starting to come down, Tesla's dropping, everything is not doing well. What is that point where we're actually going to see that turnaround? Like Elon said, a recession, anything can happen. It's an unpredictable stock market at that point. So if we're going to see that recession, see that when the Fed finally comes down to that bottom point of the interest rates, that is when we would end up seeing the market finally hit that bottom and start to come back up again.
And you see, it's not relevant to your channel necessarily, but I did look at charts to not to confirm what I was thinking, because that's called confirmation bias, which is very dangerous. In fact, I was actually trying to do the reverse, but I looked at housing as well. I looked at with a housing price index, which you can look at on TradingView, and actually the same thing was happening. It was only once that the rates, so you got the drop in price, so the market came down, and then the housing prices came down as well. A bit of a lag because houses are just more illiquid, as simple as that.
Right. Yeah.
As we know. And then you got once the rates had bottomed out, then you saw a similar sort of scenario with the housing as well, a little bit later on. So if you were looking to perhaps buy property, that you could hit a sweet spot as well there.
Right. And that I am. So that's perfect. So for any of you guys out there who are looking into real estate, it's going to be basically same buying opportunities for any sort of assets, whether it's going to be a stock or real estate. The timing to buy is going to be about the same.
Yeah, within a couple of quarters, you're going to find it. But again, you're not going to time it. And obviously, there's other factors at play, the individual stock, the individual property, et cetera, but it's the same thing.
Right. So, and if the 2025 timeframe is going to be when the market's going to hit that bottom and start coming up, and Tesla comes out with a compact car, that's going to be a good catalyst for Tesla right there.
It's a huge catalyst. And in the UK, this is something I was communicating on Twitter with, I can't remember who it was with actually, but somebody was kind of saying, I mean, because our houses here, they're all sort of Victorian terraced housing. You can't charge EVs here. Our roads were designed for horse and cart, as in they really were. It's not, we don't have what you have. Most houses here don't have driveways, for example. If you want to charge, if you live here in apartments, or which often don't have parking, or if you live just in a typical house here, you can't have home electric charging point. You can't do it. So you have to charge when you go and get your groceries, or if you go to stay at a hotel, or if you go to work. But there was a law introduced in this country that all new build properties must have EV charging points by 2025. Yep. Interesting timing again.
Yep.
Now, is Elon aware of that? The UK is a big market. The EU is a huge market. The same law as well. Please don't quote me on that. It might be slightly different, but it's the same thing. All new build properties by 2025 must have EV charging. Now whether you could say Elon's sandbagging the product, but I don't think that's the case. Not when I look at it. But ultimately, you've got a convergence here of technologies. which
Oh yeah,
is
and we've
often when great
and we
things happen.
and we've talked about it on here so many times that 2025 is just that, seems like it is that time. That year seems like it's going to be that big pivotal year for everything. And Tesla included, is just that's going to be the big year that they take off into the next monster thing, because they're going to have energy. They're going to have so much stuff going in their favor. So, just looking at now the macro data along with it now really supports that thesis even more.
Yeah.
It's 2025 is that big year.
I think certainly that's going to be, it'll be 2025, 2026, I think, is where you're going to start to see some real stuff. So, if you're looking with respect to Tesla and investing long term, you can't be looking at a 3 to 5 year time horizon, and that doesn't make sense. That would be kind of leaving the party just as the DJ's just arrived. That would make no sense. It would be insanity.
Right.
It really would. That's when you're likely to see the real convergence of all of these S curves coming together, particularly energy, as you've mentioned, which has been. I don't think the US has had a similar effect as we've had in Europe, but energy prices for most people have tripled in the last 12 months.
Yeah, we've had a little bit, depending on who you have for electricity provider. Some have gone up significantly, but not like you guys. Like maybe we go up 30%, but not 3x.
Yeah, it literally is 300. It literally is a 3x. And what that started to do is it started to, the seeds that have been sown by the different companies of, hey, we can come and do you a air source, or ground source heat pump or solar panel, things like that. You're starting to see more and more and more of that. Now, who's going to come in the game and go, hey, you know what, we've already done this. We know how to do this. Child's play to us.
Yeah.
It's the company that bought Solar City. Boom.
Exactly.
And that's it. So you've got convergence of that, and it's given us a real sharp shock in Europe, and I think that will continue to. I think usually things. I just want to make a point on this, Tim. Usually, the UK and Europe sheepishly kind of follow whatever the US does, but I think with energy, it might be the other way around. You might be the other way around, but because we've had such a shock here, people are just like, you know what, screw this. This is just getting insane.
Oh yeah. Yeah, and now that just the people are coming out in the masses of screaming for it, like there has to be reform, there has to be change.
Well, people are what you're seeing here is people are getting so annoyed and frustrated that energy bills have gone up so much. They're like, forget this. I'm just going to go and pay whatever it costs to get solar and battery. And there's loads of companies that can provide that.
Oh yeah,
even though there's a huge capital expenditure, and there's not that many grants for it at this stage. And they're just going, and they're doing it out of principle. They're not even necessarily doing it to save money. They're doing it out of principle. They're like, I don't like this idea of being controlled.
Yeah, screw you. I want independence. Get out of here.
Absolutely. Yeah. And that's it. So, again, for Tesla and an energy market, I think, and you'll have talked about it, so I'll keep it very short. The energy market is huge. Absolutely huge.
Yeah.
It really is. Everybody needs heat and light. It's as simple as that.
Yeah.
Not everybody needs a car, even in your country. Not everybody needs a car, but everyone needs heat and light.
Yeah.
Well, and air conditioning in your country for sure.
Oh yeah, depending on where you are, but yeah.
Yeah. But so it's that market in terms of total, addressable market is huge, absolutely huge. It really is. So yeah, it's good stuff. Thank you.
Yeah. Oh yeah, no problem. Thank you, Adam, for being here. And I just want to quickly go through, guys. I was reading all of your comments in here. We were just into some really good stuff here. So Sean, I saw you here. What's going on, man? Jay Lizard, you guys are in there. Karav, I saw all your comments in there. So sorry we didn't get to all that stuff today. Just a little bit shorter on time. But Adam, thank you guys. Thank you so much for being here. If you guys don't follow Adam, he is over on Twitter. If you guys are there, was it intelligent_eat?
It is, yeah. Good.
Yep.
Well
so if you guys don't follow him there, I will put that link in the description. Definitely follow him. Great information. Again, both of us long-term bulls, but we understand what's going on in the macro environment. And hopefully tonight, some of the information we provided for you guys kind of gives you some clarity as to what we could potentially see based upon historical data over the next couple of years. And again, the awesome potential that they could lead for Tesla in the future.
Absolutely. That's
excellent. Thank you, guys. Thank you, Adam. And we will see you later.